Warren Buffett saw multiple crises in his half-century-long career as an investor, such as oil shocks, military conflicts, previous recessions, September 11 attacks, etc. Those black swans made countless investors' fortunes go up in smoke. But accomplished Buffett today? In this episode, let's explore the reason. We mentioned margin of safety when discussing sweet spot. Actually, margin of safety is the core of Buffett's value investing. Buffett is famous for buying stocks in market downturns when huge margins of safety is always available well. The logic behind is the essence of value investing, buying stocks priced below their intrinsic value and awaiting for value to return. Ever since he got the margin of safety principle in Ben Graham's classic at age 19, Buffett has incorporated it into his all investing practices. It occurs to us that major classic purchases were made when the stock market stuck in turmoil, or the monetary policy started to be tightened after a look at Berkshire's track record over the past half-century. Let's take buying Washington Post Company, WPC, as an example. Stagflation was looming due to tightened monetary policy amid high inflation before the first oil crisis. And after the outburst of the crisis in October 1973, the Dow Jones Industrial Average dropped sharply and plunged 40% at most, at which time investors were eager to race for the exits. Surprisingly, Buffett bought stocks of WPC in 1973 at a cost basis of $10.6 million, and finally he held 9.7% of WPC's shares. Later, he mentioned in a letter to shareholders that WPC's intrinsic business value estimated at $400 to $500 million, but he bought when its market value was $100 million. According to the approach of margin safety, it meant Buffett bought stocks of the company at a price of 40 cents, while their fair value was $1. Namely, 40% discount, as Buffett realized the value bottom has arrived. Surely, the reason Buffett dared to bite big also contributed to his optimism for the future of US enterprises and economy. Buying in crisis has also been a credo practiced by the stock god for over half a century. Now we have an understanding of how to buy stocks in a down market, but how to find the right time for the bottom? What if the stocks fall further after buying? In fact, WPC's share price fell a further 25% during the first 2 years Buffett invested, and it's still at a loss of 7% until 1975. But Buffett said that the key was to have enough margin of safety when buying. It's not about bottoming out at the lowest price. In his view, it is far better to be vaguely right than precisely wrong. This is because the stock market will rise, and probably dramatically, before the market is better or the economy recovers. If you wait for the robins, spring will be over. Therefore, a certain amount of hibernation is acceptable. It turned out the profits of WPC grew about 35% annually 4 years after the purchase, and the stock price started to surge since then. Buffett had a 2,000% gain on WPC after holding for 10 years, and a 3,500% gain after holding it for 15 years. This is a classic example of how Buffett get rich steadily. Finding deals during crises, buying stocks at a price within margin of safety, and holding them for the long term. We have discussed Buffett's portfolio, position management, how to find great companies, when to buy and sell, and the secret of compound interest in the past 5 days. And now you get the value investing. Welcome to Follow the Richest and learn more investment tactics. Please join our community and share your experience.